So it's official, we have 7.5% inflation, the highest in the last 4 decades. With every headline is about inflation, we're seeing the stock markets going down, we have consumer good prices that are rising week by week, and we have presidential advice to higher the wages so that we can still buy those more expensive products. And guess what? The central banks are still printing money. In today's video, we are going to talk about inflation, what it will mean for you in the short and intermediate term, and what you can do. But before we are going to dive in, as always, do me a favor, hit the like button, subscribe, click on the bell, click on also so that you don't miss anything, leave me a comment, share the video with your friends if you think that's useful. Now let's get started. You will hear a lot of people say, yeah, but this time it's different. No, really, this time it is different. Because the last time we saw such a high inflation, that was in the 1980s. At that time, the inflation spiked to 14.5%. But then there was an unemployment rate of 7.5% compared to approximately 4% now. At that time there was no booming housing market, there was no stock markets at all-time high, and there was no central bank printing money into oblivion. Matter of fact, 80% of all dollars were printed in the last 22 months. No one wants to address the elephant in the room and do what is necessary, meaning rising the interest rates, stop printing money and take liquidity out of the market, although it might result into an economic recession. Because Jerome Powell most likely doesn't want his photo to be taken that he looks like this guy, the chairman of the Fed in the 1980s. So you might be asking, so what if we do those three things, why will we end up in a recession? That's a great question. Thank you for asking. Central banks are lending money to regular banks where you and I have a bank account. And those regular banks are then lending out that money for companies so they can invest, or for private persons in the form of a mortgage so they can buy a house. But if the interest rate is rising and therefore the cost of money is becoming higher, it will be harder for the companies to pay off that debt, or it will be harder for you and me to get a mortgage. So you might be asking, why not just always keep those interest rates very low? Then money is always cheap and it's very easy to invest into the future. Well, that is also not a perfect scenario, because then you're getting the current situation where money is so cheap, everyone has it, start spending it, and then you see just all the prices going completely through the roof, from real estate to food to energy, used cars, everything then is spiking, and then money becomes worthless. So doing nothing would mean more inflation, higher prices, higher salaries, and an acceleration into eternity. But by raising the interest rates and taking liquidity out of the market, you would most likely pull the trigger to get into an economic recession, and let's be honest, no one wants to have that on his resume. Do you know anyone in the last 100 years who has been elected by being honest and saying, you know what guys, I'm gonna do what is necessary, raise the interest rates, take money out of the market, we will most likely hit a recession, it will be very painful, you're gonna lose your money, your house, your job, but therefore we are able to restructure all the debt, bring the inflation down, start out with a clean sheet so we can build up wealth for generations to come. No, that has actually never ever happened. Usually if the Fed raises interest rates, that is 0.25 to 0.5% each time. But let's say they will be very radical and suddenly do 2%. Then it will still take somewhere between 3 and 6 months before you see the effect. The same happened exactly when they started printing money. You didn't see inflation right away. It took some time before inflation was picking up, and that is just because our economic system has so many cogwheels, and so much stuff is turning that it just takes time before it hits the real economy. With that being said, what do we know? We have high inflation, it's real, it's here to stay, it will most likely take a long time before it's gone. And B, you and me cannot change anything about it, because we cannot press the button to raise interest rates and we cannot fire people who are in charge right now. So what can you do from a day-to-day perspective? 2 major things. First of all, find a different job. Right now, the unemployment rate is very low, approximately 4%. That means that for employers, it is hard to find the right people. And that means that you are in a great position to try to find a different job where you get a higher wage. And you know what, if it doesn't work out, then just go to another one. Right now it's an employees market, and of course there will be a moment in time where it will be an employer's market again, and then you are happy that you maybe change your job, locked in a long contract for a year, 2 years, 3 years, and that you have a higher salary so you can fight that upcoming inflation. Number 2 is that you are going to cut down on your expenses as much as you can. Do you really need to have that $69 a month OnlyFans account or that second car in front of your door? By having a lot of liabilities, that makes you very heavy. And if the prices are rising from everything that we kind of know, then that also means that your cost per month will most likely rise. But by being as naked as possible and not having any liabilities at all, that will make you very agile for the future. From a portfolio and investment point of view, usually the rule of thumb is, in case there's high inflation, buy everything that the government can print. For example, gold, real estate, and cryptocurrencies. Gold is historically seen as a very good hedge against inflation. It had a tremendous 2019, 2020. Surprisingly, it had a negative return in 2021, and so far 2022 is also not very impressive, which is remarkable because the inflation spiked in the last 2 years. Bitcoin so far didn't really have a chance to prove itself because the last period from high inflation dated from the 1980s, but of course there's a real case to be made that Bitcoin will do good during inflation periods because of the scarcity of only 21 million. Real estate has historically also been a very good hedge against inflation, just like gold. I think I don't have to show you a chart about what happened with the prices in the last decade and what the predictions are for the next few years. So although the markets are very shaky right now because of uncertainty of the Fed, inflation, everything that's going on in Ukraine, my advice would be diversify, diversify, diversify. Try to own stocks, ETFs, real estate, gold, silver, crypto, and a little bit of cash. Just diversify as much as possible and keep yourself to the strategy. And in my case, that will be DCA, so dollar cost average every week, every month into the market. Keep your horizon on 10, 20, 30 years from now. And of course also for now, trying to cut as many costs as you can, and it might be very lucrative to change your job. Now with that being said, if you like to learn more about cryptocurrencies, there's a link in the description to the trading channel. We're placing daily videos about Bitcoin and Ethereum. Also feel free to add me on Twitter and Instagram. The links you will also find in the description. And you would highly do me a favor. If you would like this video, subscribe, click on the bell, click on all so you don't miss anything. Leave me a comment or share this video with your friends if you think that's useful. With that being said, thank you guys so much and see you in the next one. Bye bye.